Welcome to Business with Louis, the show where we explore the world of entrepreneurship and help you turn your ideas into reality. Today, we're going to talk about a fundamental concept that can make or break your business: credit. So, what is credit? In simple terms, credit refers to the ability to borrow money or resources from others with the promise of paying them back, usually with some form of interest or reward. It's like asking a friend for a loan, but instead of a friend, it's a bank, investor, or other financial institution. Credit has been around for thousands of years, dating back to ancient civilizations where merchants and traders would extend credit to each other to facilitate trade. Today, credit is a vital component of modern commerce, allowing businesses to access the funds they need to grow, invest in new opportunities, and manage their cash flow. One key concept is the idea of risk assessment. When you apply for credit, lenders evaluate your creditworthiness by looking at factors such as your income, assets, debt history, and credit score. This helps them determine the likelihood that you'll pay back the loan on time. Another important principle is the concept of interest rates. When you borrow money, you typically agree to pay back the principal amount plus some additional percentage, known as the interest rate. This can vary depending on factors such as your credit score, market conditions, and the type of loan or credit product. Influential thinkers like Milton Friedman and Friedrich Hayek have written extensively about the role of credit in facilitating economic growth and innovation. They argue that access to credit allows businesses to invest in new ideas, take risks, and create jobs, which ultimately drives economic progress. Take the story of Sarah Blakely, founder of Spanx. She started her business with just $5,000 in savings and a lot of determination. She used credit cards to finance her early operations, including manufacturing and marketing expenses. Today, Spanx is a global brand with over $400 million in annual sales. Another example is the company Warby Parker, which was founded by Neil Blumenthal and Dave Gilboa in 2010. They used a combination of credit cards, loans, and venture capital to finance their business, which has since grown into a successful eyewear brand with over $500 million in annual revenue. Research has shown that access to credit can have a significant impact on business outcomes, particularly for small businesses and startups. A study by the Federal Reserve found that small businesses that use credit are more likely to experience rapid growth and job creation than those that do not. Similarly, a report by the Kauffman Foundation found that entrepreneurs who use credit to finance their ventures are more likely to achieve success and create jobs. So, how can you apply the concept of credit to your own business or career? First, it's essential to understand your credit options. For businesses, this might mean exploring lines of credit, loans, or venture capital. For individuals, it could involve understanding personal credit scores, credit cards, and mortgage options. The key is to use credit wisely, ensuring that you're not overextending yourself and that you have a solid plan for repayment. One common challenge businesses face when dealing with credit is managing debt. It's essential to maintain a healthy balance between borrowing to invest in growth opportunities and avoiding so much debt that it becomes unsustainable. Tools like budgeting software, financial advisors, and credit monitoring services can help navigate these decisions. To manage debt effectively, businesses should prioritize cash flow management, ensuring that they have sufficient liquidity to meet their obligations. They should also consider implementing a debt repayment plan, which involves prioritizing high-interest debts and making regular payments to reduce their overall debt burden. Additionally, businesses can use techniques like debt consolidation, where they combine multiple debts into a single loan with a lower interest rate and a longer repayment period. This can simplify their finances and make it easier to manage their debt. Another strategy is to use credit to invest in assets that will generate returns, such as equipment, real estate, or intellectual property. This can help businesses build wealth over time and create a sustainable competitive advantage. In conclusion, understanding credit is fundamental for success in the business world. It's not just about borrowing money. It's about leveraging resources efficiently to achieve your goals. Whether you're a seasoned entrepreneur or just starting out, recognizing the power of credit and using it effectively can be the difference between stagnation and rapid growth. As my friend and fellow entrepreneur Gary Vaynerchuk once said, credit is like oxygen for businesses. Without it, you can't breathe. By understanding how to access and manage credit, you can unlock new opportunities for growth, invest in your business, and achieve your goals. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.